This one rule is the difference between a 46% win rate and a 60% win rate on the exact same trades. Most traders get stopped out by the wick. The pros wait for the body. Because wicks do the damage and the body tells the story. And it applies to one setup ICT has been teaching for a year that almost nobody actually trades. The first presented fair value gap. The first gap of the day. Scroll the smart money side of this app and you will find 1,000 videos on order blocks and silver bullets, and almost none on this one. So we tested it. 5 years of the Nasdaq and the S&P, every New York Open. Traded the lazy way, it is a coin flip that loses, which is exactly why everyone gave up on it. But put back the 3 rules the crowd skips, and this slept-on setup wins up to 63%. By the end, you will know all 3, and the one line that makes the whole thing click. Quick definition so we are all on the same page. When New York opens at 9:30, you wait for the first fair value gap to form, the first real 3-candle gap of the session. That is the first presented gap. ICT teaches it as a daily reference. Price comes back to it, and it becomes a decision point. And he is right that price comes back. That part is not the problem. The problem is what people do when it gets there. So let us watch what actually happens, the way most people trade it. Here's the way it gets taught and the way everyone tries it. Price comes back, it taps the gap, you buy the tap. Stop on the other side, go. Simple. We ran exactly that on every New York Open for 5 years. 45% win rate, a coin flip, and it slowly bleeds money. Watch why. Price drifts down, taps the gap, you are filled, and then it just keeps going and takes you out. Over and over. So an honest person tries this a dozen times, loses, and concludes the first presented gap does not work. That conclusion is wrong. It is not the gap that failed. It is the entry. You bought a touch and called it confirmation. Rule 1. Stop buying the tap. Wait for the close. The gap is only worth trading when a candle pushes into it and then closes back out of it, rejecting it. That close is the market showing its hand. Same setup, same 5 years, but we only enter on that rejection close instead of the bear tap. The win rate jumps from 45% to almost 60%. Same gaps, same market. One change. You waited for the candle to finish instead of front-running it. Confirmation is not a tap. Confirmation is a close. Rule 2 is the big one, and it is the whole video in one line. Wicks do the damage. The body tells the story. Here's what kills the lazy trader. They put a hard stop just past the gap. And price loves to spike a wick straight through that level, take their stop, and then snap right back. The wick is a trap. It is liquidity being taken. So we tested 2 versions of the exact same trade. Version 1. A hard stop at the edge of the gap, out the moment a wick touches it. Version 2. You only count it as a loss when a candle body actually closes through the gap. A wick through is nothing. A close through is the story. The hard stop version, the one that bails on wicks, wins 46%. The body close version wins 60%. 14 points from one rule on the same trades. The wick was never the signal, the close was. So now you have 2 rules, and each one is worth about 14 points, and the lazy trader breaks both at once. They buy the wick in, and they get stopped by the wick out. That is your 45% coin flip right there. Fix both, and you are sitting at 60. Rule 3. And this is the one we almost missed, because the data forced it on us. Not every first gap is worth trading. Some days, the first gap is a tiny 2-point nick on the 1 minute, and those are pure noise. When we included every gap, no matter how small, the strategy lost money because those micro gaps gave random, oversized losses. So we put in a filter. Only trade a first gap that is at least average size, as big as the market's normal move at that moment. Watch the line. Trade every gap, you lose. Filter to medium gaps, you are about break even. Trade only the meaningful sized gaps, and the whole thing turns clearly profitable. No magic threshold, just this. A gap too small to matter is a gap too small to trade. One more piece and it is pure ICT. About half the time, the first gap does fail. A body closes clean through it. The lazy trader takes the loss and walks away. But ICT teaches that a fair value gap that gets closed through does not just die, it inverts. The old support becomes resistance. It is now an inversion fair value gap, an IFVG. So when the first gap fails, you do not quit, you flip. You wait for price to come back to that same zone, wait for the rejection close the other way, and take the trade in the opposite direction. We tested the flip too, with the same rules, and it recovers a real chunk of those failed days. The gap holding is one trade. The gap failing is the next trade. You are covered both ways. So here is the whole machine, run on every New York Open for 5 years, almost 3,000 trades counting the flips. The rejection close entry, the body, not the wick, only meaningful sized gaps, and the flip when it fails. On the S&P 1 minute, the cleanest market for it, 63% win rate, and a system that made $23,000 on a $500 risk per trade. On the Nasdaq, letting winners run, $64,000. Across both markets and both timeframes together, over $100,000. And here is the honesty check the other channels skip. Even if you use the strict hard stop instead, the version that gets wicked more, it is still positive, almost $80,000. The edge is not a knife edge, it holds. The part the hype reels cut. This is a mechanical floor, not a ceiling, and the per trade edge is modest. It lives in the bigger gaps and in letting your winners run. So if you take every tiny gap and bail at 1-to-1, you will not see these numbers. This is the Nasdaq and the S&P, 1 and 5 minute, the New York Open, 2021 to 2026. Not gold, not crude, not your favorite token. And it depends on that wick versus body discipline. Put a hard stop at the gap edge and the wicks will grind you down. The script is public. Rerun it and disagree. What the data cannot measure is the last piece. Which gaps to skip? When the day is wrong, the read you build from screen time. We measured that in another video, and it was worth more than the setup itself. The setup is the floor. You are the rest. So here is the slept-on setup in 4 lines. 1. Enter on the rejection close, never the tap. 2. Wicks do the damage. The body tells the story. So a loss is a body close through, never a wick. 3. Skip the junk gaps. Trade only the meaningful sized ones. And 4. When it fails, you flip it. That is the inversion. That is the whole thing, and it is the one ICT setup almost nobody is actually trading. We built the tool that marks the first presented gap at the New York Open, flags whether it is big enough to trade, and tags the rejection close and the inversion live on your chart, free in the Discord, with the full data set. We test, you decide. And the next time someone tells you the first gap does not work, you will know they were just trading the wick.